Welcome back to another explainer. So, if you've been following the financial markets, or honestly even just skimming the headlines lately, you know the gold market in early 2026 has been an absolute roller coaster. I mean, we are talking about massive whiplash here. We've seen these dizzying, totally unprecedented retail peaks, followed literally days later by panic-inducing drops, and then bam, historic geopolitical rallies. For everyday investors, it's been an incredibly bumpy ride, leaving a lot of us scratching our heads and wondering what on earth is going on with the world's oldest safe haven asset.
So the big question we need to answer right out of the gate is this. Is gold actually crashing? Has the spectacular bull run of the last few years finally run out of gas? Or is the market just taking a breath, kind of building up energy and reloading the spring for another massive breakout? Well, let's dive into the data and separate the noise from what's really happening. Here's our roadmap for today. We'll start with the 2026 roller coaster, then look at what is driving prices, check out expert predictions for 2026, talk about timing the festive season, and wrap up with smart retail investment strategies. All right, let's kick things off with Section 1, the 2026 roller coaster. The sheer scale of these price swings is just wild. Gold started 2026 incredibly strong. We hit a retail peak in India of roughly 1.80 lakh rupees per 10 grams right in January. But then the floor seemingly just fell out. By mid-February, we witnessed a severe 13.5% crash, which dragged prices all the way down to 1.56 lakh. So what caused that sudden plunge? Well, it was mostly a surging U.S. dollar. Markets were reacting to Kevin Warsh being nominated as the new U.S. Fed chair, bringing expectations of really conventional monetary policy, plus reports that Russia was resuming dollar-based trade. That super strong dollar made gold super expensive for international buyers, which triggered massive sell-offs. But, the story didn't end there. Just as the dust was starting to settle, the global geopolitical landscape shifted violently. Late February and early March saw U.S. and Israel strikes on Iran, and that triggered a massive global war rally. Global prices absolutely rocketed past $5,300 per ounce. Domestically, prices spiked back up toward the 1.69 lakh mark in just a matter of days. It was this incredible, unprecedented safe haven surge that perfectly proves just how sensitive gold is to global instability right now.
Moving on to Section 2, what is driving prices? So underneath all this chaos, there are really four main drivers keeping gold at these elevated levels. First, as we just saw, is the geopolitical instability in the Middle East and Eastern Europe. When conflicts flare up, big institutional money gets scared of riskier assets and sprints straight into gold. Second, despite the recent dollar strength, the market still expects the U.S. Fed to eventually cut interest rates. Lower rates mean lower yields on bonds, which makes non-yielding assets, like gold, a whole lot more attractive. Third, we have the ongoing fluctuations of the U.S. dollar itself. And fourth, and honestly this is probably the most crucial one for the long haul, is record central bank buying.
Check out this staggering stat. In 2025 alone, global central banks hoarded around 900 tons of gold. To put that into perspective, 900 tons is roughly the weight of 150 adult elephants. That is a massive amount of gold. They are aggressively diversifying their reserves away from the U.S. dollar, a trend everyone's calling de-dollarization. This relentless buying from countries like China, India, and Turkey is quite literally eating up the global physical supply, and that puts a rock-solid floor under the price. Which brings us to this brilliant piece of analysis from the financial firm WisdomTree. They look at this current period of volatile consolidation not as a crash, but as a phase of loading the spring. I love that metaphor. The idea is that the market is just absorbing these geopolitical shocks and dollar swings, storing up immense kinetic energy for the next huge upward breakout once all the macro factors line up. All right, let's look at Section 3, Expert Predictions for 2026. Now, most experts generally agree we'll see gold settling into a near-term range of 1.5 to 1.75 lakh rupees. But just think about the end-of-year targets here. Goldman Sachs is aiming for $5,400 an ounce, which is about 1.70 to 1.90 lakh rupees domestically. And JP Morgan, they're even more bullish. They're forecasting $6,300 globally. That would push domestic prices past the totally unprecedented 2 lakh mark by year-end. These giant institutions are basically betting that rate cuts, weaker fiat currencies, and at central bank hoarding will completely overpower any of these short-term dips. Section 4. Timing the festive season. In India, gold is so much more than just a line item on a portfolio, right? It's a cultural necessity. The calendar itself basically guarantees a massive base of domestic demand. Between April and June, we've got Akshaya Tritiya and summer weddings.
Then we roll right into Raksha Bandhan and Ganesh Chaturthi, before hitting the absolute monster peak with Dhanteras, Diwali, and winter weddings in Q4. So even with prices sitting at historic highs, that mandatory festive and bridal buying is going to drive immense volume. Sure, people might buy slightly lighter 18-karat pieces, but the overall value of those sales just keeps growing.
And finally, Section 5, Smart Retail Investment Strategies. So how do we take all this high-level institutional data and actually use it? What are you supposed to do right now? Well, first off, experts are loudly warning against high-risk lump sum buying in this super volatile environment. Please don't dump all your cash in at once. Because we absolutely know there will be bumpy periods and sharp pullbacks, the gold standard strategy right now is staggered accumulation, or in plain English, buying on the dips. When the dollar temporarily surges and gold takes a hit, that is your window. Slowly build up your position over time instead of trying to perfectly time the market.
And honestly, how you buy is just as crucial as when you buy. Get this, in the first quarter of 2025, gold ETF demand in India was 7 tons. In the first quarter of 2026, it skyrocketed to 20 tons. That is a jaw-dropping 197% year-over-year surge. Modern investors are waking up to the fact that if you just want financial exposure to gold, highly liquid, tax-efficient vehicles like ETFs are way smarter than paying those heavy making charges on physical jewelry.
But having said that, even with this massive pivot to digital and paper gold, the physical market is absolutely roaring. We're seeing a really sharp pickup in gold imports into the country. Investment demand for pure physical bars and coins is keeping the market insanely active. People are aggressively buying those dips, and the import numbers clearly prove it.
So let's wrap this up. We've looked at the crazy volatility, we understand the heavy geopolitical and institutional forces pushing prices higher, and we know the smartest ways to actually navigate these choppy waters. The data is telling us that these recent drops aren't the end of the run, they are a pause before the next climb. Knowing that the spring is actively loading and knowing those year-end targets are potentially eyeing that crazy 2-lock mark, how are you going to allocate your portfolio for the rest of 2026? Are you going to be ready when that spring finally snaps? Take a good look at your asset mix, think about that buy on dips approach, and definitely stay informed. Thanks so much for joining me on this explainer, and I'll catch you on the next one.